Good evening, good afternoon, good morning, wherever you're joining us from. It's great to see you and be with you. Great to have you for the first briefing of the year. This is the event that we do just after the USDA releases their WASDE report, and we're so happy to bring it to you this month in January of 2022. My name is Jim Sutter, and I'm the CEO of the U.S. Soybean Export Council. You know, I think as we enter a new calendar year, all of us probably do some reflection and take time to think about what it means. What do we want to do? What do we want to achieve in this coming year? And for me, this gave a good chance to think about the year we've been through and all of the changes that we've seen and all of the things that have happened, and then to think about what's coming in the next year. And one of those exciting things that's coming, because as we wrapped up the last year, our board of directors approved a new strategic plan for the U.S. Soybean Export Council. And we're quite excited about that. As a part of this plan, which we'll really be now starting to implement in 2022, we have three key words that we want to focus on. Differentiate. We want to differentiate the quality and the value of U.S. soy. We want to elevate. We want to do that through collaboration with partners, with many of you around the world. And then we want to attain access to markets, access to your business, and access to trust, to a trusting relationship. For our customers, I think this means that our farmers, our leadership, and our team, working across 82 countries around the world, are going to be committed to several things. We want to make sure that we provide you with valuable data and technical expertise that will help you in your business, because we want to see you be as successful as possible. We want to make sure that our industry is supplying a high-quality product that meets your needs, that enables food, feed, and CPG companies to meet all of their goals, and that they have access to reliable and sustainable U.S. soy. And sustainability is becoming a bigger deal. You'll hear more about that later. And ultimately, we want to make sure that we help our industry deliver solutions to help businesses around the world that purchase U.S. soy be successful. I'm excited about it, and I know that our team around the world, our regional directors and all of their teams, are also excited. So we look forward to working with you in the coming year. But enough about that. You want to hear about what we're going to talk about today. I am so excited about the program that we have lined up. We have three great speakers. We're switching it up just a little bit. And before we dive straight into the WASDE numbers, we are going to have one of our regional directors give you an update on what's going on in that particular part of the world. This is something we plan to incorporate in more of these reports because we know we get a lot of questions about what's going on, and we know people are interested in that. So we're first going to hear from Rosalind Leek. And Roz is our regional director for Northeast Asia. And she brings a wealth of experience in the soy industry, and she really helps keep our team grounded with a background and growing up on a farm. And so she knows about the production side, experience in the grain trade industry, and lots of things related to the supply chain and all of those sorts of things. So I'm excited to hear what Roz has to tell us. Then, of course, we will have Mac Marshall, who's our Vice President for Market Intelligence for USSEC and for USB. He's going to talk about the WASDE report and give us a kind of an update of those numbers, give us a quick recap. And then we're very excited to have a special guest with us tonight, and that's Emily French. She's a frequent guest of USSEC, and we've heard it in your reviews that you appreciate the perspective that she brings. She's a founder and market analyst for Global Ag Protein. And I love to hear what Emily has to say about markets. I think she has a wealth of knowledge, a really unique way of looking at things. And I've often said she can help people see around corners. So we're happy to have her with us tonight. So, and always, of course, we're going to have questions. So please be typing your questions in the chat. Don't forget to do that because those will be taken at the end of our session. So without further ado, I want to thank you again for being with us here. I want to belatedly wish you a happy new year for 2022. And I hope to get out and be able to interact with many people around the world during this year. And now I'm going to turn it over to Roz, and she will give us a perspective looking at the world from Northeast Asia. So Roz, over to you.
Well, thank you very much, Jim. It is certainly my pleasure to be here tonight. I do feel quite honored to be on this distinguished list of speakers. So I wanted to kick it off just quickly to talk a little bit about Northeast Asia, which is Japan and Korea. So both of those markets are mature markets. They have relatively stable demand, and that certainly hasn't changed over the last 2 years, while even though we've been in the pandemic. We have seen some shifts in demand, but nothing substantial. The one thing that we have observed over the course of the last 2 years, particularly as a result of COVID, has been the increased demand for soy foods and particularly fermented soy products. And so as a result, that has actually increased what we've been able to supply to Japan from a soy food standpoint. The same is true in Korea. So we have seen the food bean business and the food bean demand increase. And in both cases, the US enjoys a very high market share. If you look at the overall complex within those two markets, particularly on the soybean side, but then also on the meal side, we've seen higher interest of US supply for both markets. Japan this year is ahead of year over year on both soybeans and soybean meal. So I think that there's a number of reasons that are contributing to that, and we're going to talk about that in just a moment. The one issue that we've seen that's been a little bit of a demand concern in Northeast Asia has been more on the supply side. As the veg oil complex is rebalancing, we've seen some challenges for the Korean soybean oil importers to be able to secure the supply that they have wanted. And so I'm sure we'll hear more about that this evening, but that's been the one area within Northeast Asia where we have seen a little bit of a blip. Overall, demand remains strong. So Jim had mentioned sustainability in his comments, and that's certainly something that in Northeast Asia we've seen an increased interest in. We've seen an increased interest in discussion about it globally, but when you start to focus in on particular parts of the world, I would say that Northeast Asia kind of came to the discussion a little bit late. So a few years ago, it wasn't much of a topic in either Japan or Korea. Europe was really driving that conversation. However, over the last 2 years in particular, leading up to the Tokyo Olympics, we saw a tremendous interest and shift in the attitude towards sustainability. When you're looking at Northeast Asia, you're looking at markets who appreciate choice, and they pay for that extra choice, and they pay for the extra aspects or the intrinsic values that these soybeans may have, and sustainability is one of those. So we've seen an increased awareness built among the consumers, an increased understanding of what sustainability is, which has translated into companies developing more ESG criteria and providing more reporting on that. So when you start looking at that, it comes all the way through the value chain. And then that demand has transitioned back to sustainable sourcing. We've been able to, as the US soy industry, through our Soy Sustainability Assurance Protocol, provide that solution, to provide that verification of sustainability, of sustainable sourcing, the sustainable production for the consumers and for the industry in Japan. In Korea, we have some very specific examples in both markets where there's been companies who have adopted the sustainability and they've been promoting it to their consumers, and they've seen their business grow. So just recently there was an event, and it's been announced, where Lotte Foods in Korea started labeling their soybean oil that's derived from US soybeans or imported from the US, that it has sustainable US soy. As such, that has been a key marketing opportunity for them in order to demonstrate to their consumers that they have sustainability criteria. In Japan, we've seen a number of companies adopt SSAP and adopt the logo on their products. Japan leads the world in having the most companies utilizing the logo and the most products, consumer-facing products, with hundreds of them with the Sustainable US Soy logo on it. So we're quite excited about that. When you start to compare it, everybody again centralizes on Europe as being the leader in sustainability. And I will tell you, Northeast Asia actually has higher demand for the percentage of shipments that arrive in Northeast Asia for having verification of sustainability over Europe. And so I think that there's a lot of exciting things taking place in Northeast Asia. I think there's a lot of exciting things to come. And while they are mature markets, we have nice market share, and we continue to see opportunities derived from either our food grade soybeans or our commodity beans in order to verify that sustainability. So thank you for the time. I look forward to hearing from the rest of the speakers today, where we're going to dig into WASDE and dig into the numbers.
All right, well, thank you, Jim, and thank you, Roz. I really appreciate the insights, and it's certainly really exciting when you can see that we've got, these mature markets that are still enjoying and finding novel ways to appreciate U.S. soy, and certainly through the Sustainable Soy Assurance Protocol and the recognition thereof throughout Northeast Asia is an exciting development that we continue to see unfold. But let's get right into the key findings from today's report. Now, today was a flood of market information, with USDA issuing both its quarterly grain stocks reports and its monthly updates to supply and demand balance sheets. Now, looking at both releases, here are my key observations and takeaways from the reports. Now, first and foremost, we can now officially say that the 2021 U.S. soybean crop is, in fact, the largest on record. With the upward revision to yields, the crop is now 4.435 billion bushels, or about 120.7 million tons, 5% higher than last season, and now surpassing the 2018 crop, which had been the record. Now, while on balance, the revision from the prior month's estimate is minor, only 10 million bushels, I think it's worth stating that a record crop is quite an achievement given the heat and drought pressure that many U.S. soybean farmers experienced over the summer. And it's truly a testament to our farmers' resilience and ability to produce an excellent crop in the face of these kinds of weather challenges. Second, among observations, world ending stocks were revised down by 7 million tons. Now, that's in large part attributable to substantial reductions in the forecast estimates across South America. The second consecutive year of La Nina is impacting production throughout southern Brazil, I think as many observers have noted, with about 30% of production area under stress. Accordingly, USDA dropped its estimate of the Brazilian crop by 5 million tons in a rare update to the January production estimate. Now, however, I should note that given the history of these January production estimate levels, there is the potential for us to see upward revisions later in the year. I will get into this in a couple slides. Now, moreover, even with that cut, that 139 million metric ton crop would still be a record for Brazil, and the export outlook of a record 94 million tons is unchanged from last month. Argentina, the world's number 3 producer, which saw substantial production issues last season, is again feeling the impacts of La Nina as production was cut by 3 million tons to 46.5 million tons. Paraguay, which is also in the heart of the weather-impacted region, it had its production cut by 15% to 8.5 million tons. Now, back to the U.S., and specifically looking at the quarterly grain stocks figures, inventories for the 1st of December were pegged at 3.15 billion bushels, up 7% from the same period last year. Revisions to the September 1st inventory figure were minimal, as beginning stocks were taken up by simply a million bushels to 257 million bushels. Now, I was looking for potential changes to the U.S. whole soybean export forecast in this release, given that we've had a bit of a seasonal slowdown over the last couple of weeks, but USDA did maintain its projection of whole bean exports at 55.8 million tons. Lastly, USDA issued increases to its price projections for both whole soybeans and soy meal, definitely taking into account much of the rally that we've seen for both commodities over much of the last month. Now, let's look at what the market was expecting in advance of the report. For the 2021 U.S. crop, the market was generally looking for a slight upward revision to yields and production by extension. While the production estimate came in slightly below the average trade estimate, as mentioned before, it is still a record for the U.S. crop. Now, on the next slide is the visual balance sheet for the United States to show the changes from the prior month's estimates. Here we see the increases in green in the chart on the right, the uptick in production, the reduction in soy meal exports, counterweighted by higher soybean oil exports. Now, with no changes to the crush volume or export volume, the upward revision to the crop size translated into a slight increase in projected ending stocks. Now, for reference, the projected ending stocks to use ratio is 8%, which is higher than last year, but still supportive for price. Now, here on the next slide, we have the pre-release market consensus for December 1st inventories. Now, the figure came in slightly above the average trade estimate, and as mentioned before, is up 7% over prior year levels. The September figure is virtually unchanged from last month. Now, turning to projected ending stocks for both the US and the world, with on the next slide, with the aforementioned upward revision to the crop, US ending stocks were also revised up slightly, with that 10 million bushel increase in the crop size directly translating into higher carryout and in line with the average trade consensus of roughly 350 million bushels. Now, on the world level, however, inventories came in markedly lower than what the market was expecting, providing probably the largest market-moving figures today. We certainly saw an upward price response following the report's release earlier this morning. And taking into consideration that drop in ending stocks, let's turn back to South America, because the reason for that reduction is really tracing back to the cuts in South American production. Estimates for both Brazil and Argentina came in below the trade average expectations, but Brazil was even lower than the low end of the surveyed firms that provided estimates. Now, it should be noted, however, that even with that 139 million metric ton figure, there are some other private sector estimates that are out there that are accounting for potentially even steeper reduction in the Brazilian crop size. Now, I said a few minutes ago that there's some history worth discussing regarding the production estimates for Brazil. Now, if we look over the past decade in the chart on the right here, where the red shading indicates marketing years in which the January figure has overestimated production, the green shading instances in which January is underestimated production. You can see in the chart on the right that for Brazil, January has had a tendency to overestimate the crop size. Now, you don't typically see revisions of the crop size in January, but with this year, with I think enough of that pressure coming in heat and dryness in the southern part of the country, USDA felt it warranted to make that change. Now, I've also called out on the charts here the years in which La Nina was in effect. Those are bolded and underlined, and you can see for the 5 La Nina years which have taken place over the last decade plus, you've had subsequent upward revisions to the Brazilian crop size relative to January. Now, for Argentina, it's a little bit more of a mixed bag, where the January estimates have tended to get smaller as more data on the crop becomes available. You see all that denoted in the red shading there. Now, I think these points are really worth considering as we assess market conditions leading up to the planting of the U.S. crop later this spring. Certainly, the potential for subsequent revisions to South American balance sheets will be a critical driver of prices over the next quarter. Now, lastly, just to recap, here are the key takeaways from today's report. First, the 2021 soybean crop was revised up. It's a new record. We have world ending stocks down 7 million tons owing to the production cuts across Brazil, Argentina, and Paraguay. U.S. inventories for the quarter are up 7% on the year, slight upward and growing naturally relative to September 1st. This is the seasonal pattern post-harvest. No changes to the U.S. export forecast, and the overall price outlook for both whole soybeans and soybean meal as articulated by the projected marketing year average price by USDA. So it's certainly a rosier price outlook going forward. So this concludes just kind of the quick recap of the main things that jumped out to me for the soy complex in this morning's reports. It is now my esteemed pleasure to welcome back to the program Ms. Emily French. Emily, how are you? Great to see you.
Sorry, I couldn't figure out my mute button. It's a little too much for me after all these numbers today and going through everything. Goodness gracious, bananas.
Well, you can't spell numbers without num, so I hear you.
There you go, exactly.
Yeah.
But I figured it out, so we're game on, game on. Good to see you, great to be here, and hello around the world.
No, well, it's January is always an important month for the trade because you do have so much data coming in. I've run through the things that jumped out to me and at least what the trade was looking for. Starting with soy, what are some of the things that really jumped out to you from today's reports?
Right, so let's just step back for a hot second and kind of set the stage. 2021, the market was heavily focused on the supply side. It was heavily focused on the US balance sheet. So this time last year, there were a lot of people saying, well, the US ending stocks has the potential to go negative. It's going to be super tight, all these things. Brazil ends up producing a record crop, bingo, bango, and that marketing year's put to bed. As well last year, so, supply side and then inflation and more inflation. That was the talk. It felt like it kind of became the self-fulfilling prophecy. And 2022 is kind of starting again with those central themes: supply side concerns, inflation, and Bob's your uncle, if you will. But I think first and foremost, money flows absolutely dominate the space. It's not technicals, it's not fundamentals. It's really all about the money flows, and it's in a given day. So pretty dangerous environment right now, frustrating, volatile. Some days you feel like a hero, and some days you want to throw your computer out the window.
Can we actually pause on that for 1 second? So
Sure.
What has the speculative money been doing, leading up to this report over the last couple of weeks?
Right. Well, the only key on the fund side seems to be the buy key. So I don't know if the sell key is missing or if it was taken away by the risk managers, but it's been a consistent bid under this market. So clearly, given the structure and the market structure, the market's heavily long corn, decently long soybeans, pretty heavy long meal. Okay long in soy oil, and it's been short or building shorts in Chicago wheat. So we're almost through the index rebalancing, and again, plenty of money is already pointed at this market. Probably the key now that the January reports are behind us is, does this weather system change and do the rains come to fruition literally this weekend and really through last half January? I think February rains, or this rain cycle, and then what we see in February will be very important, obviously for Argentina, all of Argentina, and then the southern part of Brazil. But let's make no mistake, central and northern Brazil is going to have a beast, a monster of a crop. Is Mato Grosso at 40 million tons? It's quite possible. If weather doesn't shape up, that's pretty much the equivalent. 40 million tons is what Argentina produces. That's a monster. That's a monster crop.
And I think to put it in context as well, you look at the areas that have seen the dryness and weather stress thus far, it's predominantly located in the south in Paraná and Rio Grande do Sul, which you put that together, and it's basically counterweighted by the production in Mato Grosso right now. So, whether the projection is, 139 million tons or I think anything in that ballpark, we're still looking at a large crop coming out of Brazil, over the next, several, weeks and upwards of 2 months while it's being harvested. So that'll be hitting the market, I think, in grand force. Now, how primed is the market to be receiving that over the next couple months, where the U.S. is really kind of in this pre-planting period right now and really looking ahead towards the cultivation season. So as the world's looking at Brazil, what does the demand picture look like overall?
Okay, so this is where I probably get a little grumpy, if you will, because I have a problem with demand. I think demand has been grossly overlooked because, again, 2021, it was supply side in the US balance sheet. So first, the very first and probably most important question going forward in 2022 is, does the market trade the US balance sheet? And if so, I think there's a lot of upside to the ending stocks number for the US this year. Or does it trade the world balance sheet? And if it trades the world balance sheet, I also have problems with that, again, on the demand side. So I'll take you through a couple examples of what we're talking about. So ending stocks, as you pointed out, were reduced. I look at it from a supply cushion basis. So the world consumes 1 million tons of beans every day. That really hasn't changed much. We're trying to hit that 1 million tons. And every year we talk about it. And maybe this year I don't know. I don't think we're going to do it this year. But it's 92.7 days of stocks. So about 93 days. The last time we were at this level was in 15-16. Okay. So,
and of course, I think, pretty much everybody on this call is, recalling what the next couple of years look like in terms of overall price environment, and
right.
And kind of you had that stocks rebalancing. So are you thinking we could potentially be going through another rebalancing like that, where unlike last year, where everything was really born on the supply side, and
right.
the market was really trading potential shortages, we could be on the inverse of that position this coming marketing year, if I'm hearing you right?
Completely and totally. So for me, my ending stocks for the US will range between 500 and 550 million bushels. The last time we were over 500 was in 1920, and that was at 525. The farm gate price was $8.57, $8.57 a bushel. USDA raised theirs to $12.60 today. So I think what happens when you start looking at numbers and you compare where we are really on a supply basis and a price basis is that there is a lot of inflation and fat built into these numbers in a year that we're going into where I've got demand problems out of China. Marketing year to crush is down 7.5%. USDA did not change it today. It's at 4.3%. If you even take crush to unchanged versus last year, you lose 4 million tons of demand. You take it down.
Can we stay?
Yep.
No, can we stay on that for a second? Because because I do want to talk China, and I do want to talk the largest or one of the largest consumption channels for soy meal, which is of course the pig herd. Now, we have these quarterly updates that come out for the livestock and meat side of the balance sheet, and January was one of those releases. First number I go and look for is the Chinese pig crop. It's just obviously been garnering substantial headlines over the last 4 years since the onset of ASF in 2018. And we saw a pretty substantial revision to the 2022 number relative to October, high enough so that it's again showing annualized increase over the production level projected this time last year. But if you're taking that and reconciling what you're saying around crush and meal demand and overlaying that with some of the cuts that we saw, coming out of China statistical agencies on corn consumption for feed, something about this just doesn't all square with me.
Sure.
Can you help me reconcile that a little bit?
Well, I'll do my best. One, hog margins have been just awful for 6 months. China crush margins were largely negative for much of 2021. They've gone back to negative crush margins now. Meal inclusion rates. Yeah, you hear this constant talk. Do we do 18%? Do we do 15%? Is it going to be 13%? So there's a lot of difference in inclusion rates. Again, in this margin environment, you've got feed wheat substitutions, you've got any sort of substitution. So I think that a lot of that is happening. I think also the market has forgotten that China is actually the world's largest soybean stock storage tank in the world. Period. It started this year, which is interesting because USDA did not cut US soybean exports, despite the fact, and it's a fact, that exports are down 9.5 million tons. Bookings are down almost 13 million tons. China business known out of the US is down 9 million tons. That is a big hole. And just because Brazil's crop got smaller does not translate to this idea that this hole is going to be dug out. I think, if anything, a smaller Brazilian crop actually allows the US to have a much more normal or stronger start to the 22-23 export program we got this year.
It's interesting anytime you're looking at annual increases, right? I mean, this year, where we are in terms of export pace, just focusing on whole beans, as you've noted, those volumes to China are down. The commitments and everything are down as well. Now, granted, we're reconciling that against an absolute blowout of a year last year. First time we crossed 60 million tons in exports. So, maybe not the most fair comparison, but on the other side, when we look ahead to 2022, as you're pointing out, having a bit more of a normal start, it'd be hard for us to get off to I think a slower start at the start of our export marketing year. I mean, look, it was
for obvious reasons.
Exactly, the vagaries of weather. Anytime you're having that terminal disruption, as well as us coming into the season with lower inventories.
Yeah.
But if I'm hearing you as well, like it looks like there'll be potential upside on that inventory level relative to where it's stated today, which potentially puts us in the position to hit the ground running on September 1st and, kind of resume what is more of a seasonally appropriate export pace.
Yes.
But let's look between now and then. As you said, China's got these very large inventories. We've seen this before with corn. We've seen this before with wheat. Basically all the strategic reserve grains. That can't stay in storage forever. So what happens over the next couple quarters as we look ahead to the start of the U.S. marketing year?
Yeah, so in a world according to me, is this idea that, China has 108-day or 113 days of supply. That's a new record. Their ending stocks starting this year were double. They've over doubled in a 6-year period. So they have plenty of soybeans in stock. I don't think, especially with crush margins turning negative, they're largely covered for Q1 of this year. So Jan, Feb, March, largely covered. By the time they need to be buying April, May, June, I think they stay pretty close to hand to mouth or just as necessary, especially if there's no weather threat, because as we go April, May, and June, we kind of have our hands on what the US is going to be planted or planting and the weather there. So I just don't see this demand reversal out of China for more US soy, first and foremost. Europe is a problem. It's not just China. I think we've overlooked the COVID lockdowns. I think we've overlooked African swine fever there, bird flu, China's import tariffs on pork starting in 2022. What does that do to European pork exports and just the feed industry there? Case in point, their marketing year to date meal imports from 1 July to 9 January, the numbers that came out Tuesday, those are down 10.6% or just about 1 million tons. USDA is calling it's supposed to be up 1%. That's the world's largest meal importer. Okay, they're down 11%. Their beans, they're the world's second largest bean importer. Their imports, 1 July, 9 January, they're down about 1 million tons. Again, you've got a problem there because USDA does look for a minor increase to that. And I apologize, the meal actually imports for Europe are forecast to increase 2.2%. So they're down 10.6%, but they're supposed to be up 2.2%. So you have some problems in Europe that I don't think really have been recognized. And let's really go back. China's soybean imports for this year, if they do 100 million tons, which I don't believe they will, that's an increase of like 4 vessels, 4 Panamaxes. That's all the world's largest soybean importer is increasing. So, a little bit of context, the largest soybean importer, growth is actually going to be Egypt.
Well, Egypt has naturally been a bright spot. Actually, recently we had the opportunity to participate in as a USSEC aquaculture conference over there, where we got to meet with a lot of local producers, and I didn't even have a full appreciation for how burgeoning the aquaculture sector is over there. So you look at that, overlay it with poultry as well.
It's exciting.
Been a great growth. Yeah, it's fantastic, and I think that's where, when we talk about China, we talk about the European Union and, kind of these traditional larger number 1 and 2, block destination markets for us, I think it's also important to look at the diversified channels that we serve as well. So, I think there's still bright spots in some of that too. I mean, Philippines last year, for example, one meal destination. We saw a substantial drop off relative to the prior year. They've been dealing with ASF, and I think we're seeing a bit of a rebound in that, just at least in the volumes that are going there. And as you highlighted, Egypt, fantastic overseas market for the whole bean side. Mm-hmm. Now, we're starting to get some questions roll in, and I'm encouraging the audience to continue submitting questions, because I think it's an incredibly dynamic environment. I want to go back to some of the inflation questions, because we had the CPI numbers come out. We're looking at 7% annualized inflation. It's something I always track. I used to work for the agency, so it's close to my mind all the time. But let's drill in, not necessarily on the consumer level. I want to talk about what's impacting on the farm, right? We've seen fertilizer prices. They've come down a little bit in recent weeks, but the levels that we're at, you can't go in farm circles without talking about input costs, fertilizer, and of course, crop protection as well. We've seen a lot of supply disruptions. We've got some tariffs in place, which are, potentially exacerbating some of that. What do you see as you look ahead, maybe a quarter towards when crops are going in the ground? Do you see any material impact on potential rotations here?
Not today. Okay. A lot of people are going to talk about planting ratios and cost of fertilizers and run models. I'm not that minutia. Maybe I'm just not that smart, and that's fine. But
vehemently disagree. But go on.
But really, at the end of the day, it's about weather. And being able to either, is there, corn seed available? Is there soybean seed available? So let's begin and end there. I grew up on a farm. My parents are like, oh, we have to pay our fertilizer bill, for this year because of tax reasons. So let's the farm sector has had a very, very good year. And if they're able to lock in some of these prices, even today, they'll have another very good year. So I look actually for pretty normal crop rotation when it's all said and done, for the various reasons. Maybe the northern plains is a bit more loosey-goosey, fluid, but outside of that,
there's so much. There's so many. Various. It's a very diverse cropping region for the U.S. So there's a lot more that's potentially smaller acre crops to factor into the rotation decisions there. So I guess taking that and thinking about what's going to go in the ground and then looking ahead towards harvest time, I want to go back, because we're getting questions as well about some of the balance sheet expectations, right? Sure. If you're seeing inventories potentially grow, everything we've talked about thus far, it seems that your projected growth in ending stocks for September 1st, 2022, relative to what the expectation is now, is going to be predicated on a little bit more tepid demand between now and then.
Right. So case in point, the export number, USDA is looking at minus 5.9 million tons versus last year. Okay. Yeah. Bookings are down almost 13 million tons. Actual exports are down 9.5 million tons. I don't see any big demand shifts Q1 or Q2. So a lot of that comes from exports, certainly. And then second to that, actually, crush got off to a very slow start. Q1 crush actually underperformed, especially if you look at the profitability of crush margins, et cetera. So you need to keep an eye on the monthly crush rates actually for the US. They need to outperform versus last year. And that could well be a challenge. Now, that is a small fragment of why I'm 200 million bushels or 150 to 200 million bushels higher than USDA. A lot of that's exports, and a lot of that's poor world demand. And the inverse, right? You've got a cash inverse in the market. You've got a freight inverse in the market. Like, what does that tell you? Buy as little as you can up front, buy the deferred, which is why you're seeing 2022, 23 new crop soybean sales to China in the last plus week. Case
exactly. And you've got roughly a 70-cent break between old crop and new crop. If I'm just looking at the futures curve from earlier today, but still a great pricing environment for new crop. But for sure. For a farmer, I'm getting for a farmer, very, very important point of consideration. I have my USB hat on for sure. But when and we do have a lot of farmers tuning in for sure here, but, as I'm hearing, potential bearish sentiment coming out of you, looking ahead towards when we are at that harvest time piece, it seems like, the pricing opportunities that farmers have right now are, pretty strong. And like you said earlier, when we were looking at, those higher stocks to use ratios, when we were at a stocks figure of 525 million bushels, to say nothing of when we were at 909.
Right. That was fun.
Yeah, exactly. I mean, sub $9 beans right then. And, as you paint the, supply side picture of it as predicated by, waning demand over the balance of this year, as you look at that, it's certainly presenting from a fundamental standpoint an environment where we could see, prices tail off later in the season. And I'm putting this out there because I think, we want to factor it into, the consideration of me, maybe the farmer audience that we have online here.
Well, I think, if I look at it, the Friday's close is going to be really important. We made new lows for the week following the release of the report. So March bean close, really the entire curve will be quite important on Friday. If it doesn't close over 14.11 and it rains and the rains come, again, you've got to remember that this market's giving you almost a $2 bushel rally coming out of Thanksgiving. If you're a farmer, an inverse says you should be selling your crop. Don't worry about quality, get it into the physical channels. And if you want, replace it with some sort of option, structure. I prefer buying options because it's a known risk premium. But there's lots of things you can be doing. But the market's saying, obviously it's saying sell your beans.
So I wanted to just go back a little. In terms of the Brazilian expectation, the Brazilian crop estimate right here, and I feel that even with a 5 million ton cut, and we did see a upward swing across the price curve today, in part predicated on that, but it felt like a lot of that reduction was kind of already priced in the market over the past couple of weeks. You'd mentioned the $2 premium or $2 appreciation since Thanksgiving. A lot of that's really trading the South American weather market. So I've got a question. Could we see a price break and head back to sub 13 levels potentially if we see a subsequent upward revision to that Brazilian crop figure?
Right. So what I thought was interesting today is that the crop was cut out of Brazil, but the exports were unchanged.
Yeah.
Which says to me that Brazil is going to use all their port and FOB capacity, and they have invested gazillions of dollars. And that northern port, the northern region, it's a very short transit time. Bingo, bango, bongo, right into China and others. They're going to move the crop out. Right now, I mean, crush margins are quite good there. I would say that the crushers are actually probably the principal bid for soybeans and are kind of setting the tone for cash premiums. But that's really by and large because there's not a deep bid in the export grid. China's got negative crush margins. And don't forget, the Lunar New Year actually comes much earlier this year. It starts the 1st of February. Okay, that's 19 days from now. And so China's going to be quiet, I think.
So we'll see a little bit of a disruption in the seasonal pattern, and as the purchases leading up to it, and then the lull, and then potential resumption thereafter. It's skewed at a different point in the calendar. You mentioned U.S. crush just a couple minutes ago in terms of that being obviously a big chunk of our utilization on our domestic balance sheet. Nearly 60 million tons, the projection for this year. We certainly have a lot of announcements of new crush plants coming online. In the latter this year and beyond over, 22, 23, 24. Yep. And it seems like a lot of that is really underpinned and predicated by, what we've seen as a substantial appreciation in soybean oil values over much of the last year. Now, over the past couple of weeks, we've seen, oil more or less tread water, and I'm sure there's a silly metaphor in there somewhere. But we've seen meal prices appreciate and gain some more steam, relative to where they've been before. One, in your mind, what has caused some of this recent change, and what's your expectation for the next quarter in terms of meal and oil, the co-product performance?
Right. So meal is actually what kickstarted the entire rally in beans. It wasn't weather in South America. It was the recalibration of oil share. So oil share went from 49% in late October, mid-October, to sub 41% here recently. So that is, or has been, a large part. And all you have to do is look at the meal chart. And when meal wakes up, it's angrier than I am when I haven't had sleep. I mean, it just goes. And that's what we saw, and that's the nature of meal. Technically, and I mean, it's not a technical term, but I think it's dumb. And it's stupid, especially when you've got the world's largest meal importer. Imports are down 11%. That's a problem. And then you just have the Argentina has kind of been, the cherry on the cake, if you will. I think oil share is probably key. That's what I'm watching right now and have been. It's trying to build a really nice base, about 41%. I think the edible oil story is much more compelling. I'm not always Betty Buzzkill on the bear side, I swear. I do think edible oils is interesting. But I do think that as long as inflation and food costs are in the headlines and the market's talking about them and governments are talking about them, that this whole food versus fuel debate is front and center. We saw that today with the Biden administration possibly rolling back some of the renewable fuel targets. It's a problem. It's a problem because under this pandemic, people, the starvation rates, I mean, people are still starving and the world is burning food for fuel, whether you agree with it or not. I mean, that's just a simple fact. But the more that food costs and inflation are in headlines, the more pressure or the more defensive the fuel portion of that demand growth is probably going to be under. And we are seeing that.
Yeah, no, I think there's certainly been an increase in the cadence there, and that's where I'd be remiss if I didn't point out. I think the beauty of working in the soy complex, which is where it's a protein seed that produces oil, or it's an oil seed that's predominantly protein. So we've always had the benefit of producing for both parts of that food and fuel complex. So from a soy perspective, I'm of the mentality it's not food versus fuel, it's really food and fuel kind of coming together. One way or another, we're going to be supplying the market in both channels, and I think meeting those critical challenges that we're going through right now. But that's not to say that inflation isn't grabbing headlines front and center. We're seeing it all stages of the value chain, really starting at the farm. We've talked about fertilizer, we've talked about crop protection, we've talked about seeds, and these are all of course critical inputs for farming. So we're headed into a really interesting quarter as we move towards planting, and I want to go ahead and say thank you so much for joining, Emily. I really, really value, and I think I speak for a whole audience here when I say I value your insights and candor. I'm walking away from this, I feel better educated, which is always a plus. And I'll also use this as a plug here as we talk about plantings. We're changing the cycle for 2022 of these webcasts. Instead of doing one in February, which is typically a tepid month for supply and demand estimates, on March 31st, when USDA is releasing its prospective plantings report, we'll be doing a webcast in the evening then, joined by a couple of our farmer leaders. So you'll get to hear perspectives straight from them. There are a lot of questions on rotation, a lot of questions on input costs that came up today. This is a chance to hear from people who are living it and really experiencing it. So I really encourage all of you to tune back in for that. That'll certainly be a market moving report, set the stage for what can be expected over the balance of the growing season. So with that, we've got a short poll coming up just at the close of the program here. Really encourage all of you to respond to that. Certainly we've changed the format here. I think definitely for the better. Getting to hear any insights from our regional directors is always exciting. I think that's always an opportunity to learn something new. But we want to hear your your perspectives as well, as particularly as we roll out some changes in the program. We want to continue to bring great content, great insight, great analysis from esteemed speakers such as Emily and the other great speakers that we'll bring on later in the year. But for now, again, I'm Mac Marshall. I'm the Vice President of Market Intelligence for the United Soybean Board and for USSEC. And thank you all very, very much for joining. And special thanks to Jim, Emily, and Roz for joining and being on the program. Have a good evening. Have a good morning from wherever you're joining. Take care.